3.85%.
Mm-hmm.
That is the number. If you take nothing else away from the absolute carnage of this past week, burn that figure into your execution algos. 3.85%.
It's the number that woke the entire street up on Tuesday morning. And quite frankly, it's the number that put a bullet in the head of the pivot party the equity guys were trying to front run.
Welcome back to the weekly wrap-up edition of Global Macro Pulse. I'm your host, covering the geopolitical fractures, the liquidity cycles, and, the systemic risks that the headlines usually miss.
And I'm here for the price action, the volume profiles, and the hard data that either confirms the thesis or completely blows it out of the water. And looking at the screens this week, the data is screaming at us.
It was a violent wake-up call, wasn't it? We're recording this on Friday, February 6th, 2026. And let's just cut through the noise immediately. The inflation is dead narrative. It didn't just stumble. It was taken out back and shot.
Correct.
We saw the Reserve Bank of Australia, the RBA, come out of what felt like left field on Tuesday with a surprise 25 basis point hike. That took the cash rate to that 3.85% level.
And the market hated it. I mean, you saw it in the price action. The ASX took a complete nosedive, but the ripple effect was instant across all the G10 currencies.
And this is the point. This is where the retail crowd gets completely lost. They look at Sydney and they say, well, that's a commodity currency story. That's isolated. Wrong. That is a dangerous miscalculation.
It's the biggest mistake you could make right now.
The RBA is the canary in the coal mine for global liquidity conditions. They didn't hike because of, some leftover supply chain issue.
Yeah.
They explicitly stated in their presser that inflation is rebounding in late 2025 and heading into 2026 because of private demand.
It's the sticky services inflation. That's the ghost in the machine. It's the consumer who just refuses to die.
Exactly. Private demand is exceeding all expectations. Capacity pressures are rising again. Now, just map that thesis onto the U.S. If Australia is seeing a secondary inflation wave driven by domestic demand, what on earth is the probability that the Federal Reserve is sitting on a powder keg of the exact same composition?
Got to be close to 100%.
The whole immaculate disinflation thesis relies on the idea that the last mile is easy. The RBA just proved to the entire world that the last mile is a minefield.
And the FX market priced that risk in, milliseconds. The dollar index, the DXY, just ripped off the lows. We hit a 2-week high this week, comfortably reclaiming that 104 handle.
It was a violent move.
A very violent move. And we saw the pound sterling completely collapse, which we definitely need to dissect. But the volatility skew in the options market is really what caught my eye.
What are you seeing there?
The skew is shifting aggressively towards puts on risk assets. It means traders are realizing the synchronized easing cycle, that global liquidity injection everyone was betting their book on for Q1, is dead. It's over.
So we've moved from global synchronization to global fragmentation.
That's the perfect way to put it.
And right in the middle of that macro realization, the U.S. equity market decided to finally look at the valuations in the software sector and just vomit the SaaS apocalypse, as the desks are calling it.
It's about time. Really, we've been watching the volume divergence for weeks, but the dam finally broke this week.
It really did. But before we get into the tech wreck and the really systemic red flags that are flashing the U.S. banking stress tests, we absolutely need to clear the decks on the central bank divergence. This was super central bank week.
It was.
It was supposed to be the victory lap for the doves. Instead, it was a brutal reality check.
So let's check that rear view mirror. We've covered the RBA shock, but I do want to push back on one thing. The bond market reaction wasn't just about Australia.
Go on.
The entire global sovereign yield floor moved up on Tuesday. You have to understand, if the RBA has to hike in 2026, then the terminal rate assumptions for both the Fed and the ECB have to be re-underwritten. The math just doesn't work otherwise.
So you're saying you can't have the U.S. cutting rates down to 3% if the rest of the developed world is still battling a second wave of inflation.
Exactly. The arbitrage is too great. The capital flows would be too disruptive. It pulls the Fed's terminal rate higher, period.
Which means the higher for longer nightmare scenario is back on the table.
It's back.
But then you pivot from Sydney to London and you get a signal that is, diametrically opposed. The Bank of England, the knife edge decision.
Whoa, this is a trader's dream if you were short cable. Thursday, the BE holds rates at 3.75%. Okay, fine. But the vote split 5-4.
That is as tight as it gets without a literal coin flip.
It is. 4 members voted to cut to 3.5% immediately. I mean, Bailey is basically holding the line by a single thread. The market looked at that vote count and said, okay, the cut is coming in March, it's guaranteed.
And that's the divergence right there. That's the fragmentation. You have the RBA hiking to kill demand, and at the same time, the BE is desperately trying to find any window to cut because the UK economy is just sputtering.
And that divergence absolutely crushed sterling. It broke below 1.25 against the dollar almost instantly on that news.
It's a classic relative growth trade. Long USD, short GBP. It's the oldest play in the macro book.
It is, but it also introduces this massive volatility. If you're a macro allocator, you're looking at these completely opposing signals and you're realizing there is no global policy anymore. There's no unified front. Every central bank is fighting a totally different war on a different timeline.
And then there's the ECB, just sitting there in the middle, doing absolutely nothing, held at 2.0%.
The wait-and-see approach.
It feels more like paralysis to me. It really does. They seem comfortable with the euro weakening against the dollar because, it helps German exports. But they flat out refuse to commit to any kind of rate path.
Lagarde is effectively saying, we hope inflation settles down, but we really aren't sure.
It's uninspiring. And frankly, in this kind of environment, uninspiring gets you run over by the market.
Speaking of getting run over, we have to talk about the Bank of Japan. I mean, the yen pairs have been a complete widowmaker trade for the last month.
The BOJ is playing a very high-stakes game of chicken with its own bond market. They've made it crystal clear they are not going to step in and rescue the JGB market from the route that's been driven by Takaichi's new fiscal policies.
They're letting yields drift higher.
Which is incredibly significant for anyone, and I mean anyone, who is running a yen-funded carry trade. If JGB yields rise, the spread between them and, say, U.S. Treasuries tightens, and the entire carry trade has to unwind.
And it unwinds violently. We saw some really jagged price action in USD/JPY this week, but the real alpha, the real opportunity is coming next Friday.
The Tamura comment.
Correct. Naoki Tamura is the hawk on the board. He's the one to watch. He's scheduled to speak next Friday specifically on the wage price spiral.
And the market is hanging on his every word.
It is. The options market is currently pricing in about a 40% chance he confirms that the wage spiral is becoming self-sustaining. If he does that, if he gives that signal, well, that's the green light for a BOJ hike. And USD/JPY could crater. I mean, we could see a 300-pip move in an hour.
So keep your eye on the Tokyo wires next week. But now, we really need to bring this all home. We need to execute the local deep dive into the U.S. market. Because while all the central banks were confusing the global narrative, the U.S. market started to crack in very specific, very dangerous ways.
Let's talk about the price action in tech. Let's talk about the SaaS apocalypse.
The headlines are screaming about a sell-off, but this is much more than just simple profit-taking. I think this is a fundamental rethinking of the entire AI trade.
You have to look at the volume divergence. On the major cloud and analytics names, we saw distribution days just stacking up all week. Heavy, heavy volume on the down moves, and then really light, anemic volume on any of the intraday bounces.
That is institutional offloading, plain and simple.
It's the smart money using any retail dip buying as an opportunity to get out of these stocks, trading at 50x sales multiples. They're selling into strength.
And the catalyst for it all, it seems to be the Capex realization. We got the new data on Amazon's projected Capex for 2026, and the number is just staggering.
It dwarfs all of their peers. It even dwarfs their own historical norms by a huge margin.
And the market is finally doing the math. Investors are looking at Amazon, they're looking at Microsoft, they're looking at Google. They are spending hundreds of billions of dollars on GPUs and data centers, and the question is no longer, how cool is the technology? The question is, where is the cash flow?
It's the ROI gap. It's huge. I mean, look, we saw Anthropic launch their new Claude model this week. The tech is incredible. It's faster. It's smarter. But the financial toll of training that model, the cost of inference every time someone uses it, it's compressing margins across the entire board.
This is the moment. This is the moment AI hype slams directly into balance sheet reality. If Amazon has to spend $80 billion a year just to maintain its position in the AI race, that is $80 billion that isn't going to buybacks.
Not going to dividends.
And isn't dropping to the bottom line.
Yeah.
And for all the downstream SaaS companies, the guys who are supposed to be selling the software on top of this new infrastructure, they aren't seeing the productivity boom yet. They're just seeing their own costs rise as they pay the cloud providers.
Exactly. So what you have is a classic valuation compression event. The NASDAQ 100 feels very heavy here. The semis, like Nvidia, are trying to hold up the tent, but if software collapses, the semis eventually roll over too. You can't sell chips if the software companies go bust.
It's a domino effect. But there is a bigger, much bigger systemic risk brewing under the surface. While everyone was watching Nvidia and Microsoft charts, the Fed released a document on February 4th that should have stopped every single bank analyst in their tracks.
The 2026 stress test scenarios.
Usually these are just bureaucratic, box-ticking exercises. But not this year. The Fed is signaling something very specific.
Let's break down these severely adverse scenarios. They always assume a deep recession, 10% unemployment, GDP contraction. That's standard stuff.
Yeah.
But you have to look at the asset price assumptions.
That's where the alpha is.
They are testing specifically for a commercial real estate, that CRE price drop of 39%.
39%. Let's just sit with that for a second. That is not a random number. That is a specific calculated level of pain they are modeling.
And you have to compare that to previous years. It's a massive escalation. So the question is, why is the regulator suddenly testing for a 40% crash in CRE?
Because they know that's where the leverage is. It's sitting on the balance sheets of the regional banks. They are staring at the maturity wall for all these office and retail properties coming in 2026 and 2027, and they are terrified.
This is a macro headwind that is acting like a silent killer. The KRE ETF, that's the Regional Banking Index, it's been sluggish. But this stress test is the Fed telling you directly, the write-downs are coming. It's a warning shot.
And you have to remember, if the RBA is right, and we are actually in a higher for longer world than those CRE loans, they don't get refinanced. They get defaulted on. A 39% drop in the underlying asset value wipes out the equity tranche and eats directly into the senior debt.
That is a solvency event for the smaller banks. It's a huge problem.
So the Fed is forcing them to capital buffer against a potential implosion. That implies credit contraction and implies tighter lending standards for everyone else. That is deflationary for the real economy. Even a headline inflation is still high.
It's the worst of both worlds. It's a credit crunch, meaning sticky inflation, a stagflationary impulse.
And speaking of things that just don't match up, we need to talk about the U.S. Treasury Department. While the Fed is over here worrying about bank solvency, the Treasury is just flooding the zone with new supply.
The quarterly borrowing estimates. This is the supply side of the equation that nobody wants to talk about. Q1 borrowing is now set at $574 billion.
Let me repeat that. $500 billion in a single quarter.
And Q2 is projected at another $109 billion, and that's assuming a cash balance of $850 billion, which might be optimistic.
This is fiscal dominance in its purest form. The market has to absorb $574 billion of new paper. I don't care how dovish you think the Fed might want to be in the future. The supply dynamics right now are just brutal. Who buys all this paper at these yields?
The primary dealers are already heavy on inventory. We've seen it in the data. We've seen the repo rates ticking up. The plumbing of the system is getting clogged.
And this brings us to the most interesting and maybe the most important signal in the market right now, gold.
Gold has been defying gravity. It makes no sense on the surface.
Think about it. We have the DXY at a 2-week high. We have yields pushing up because of the RBA and this massive treasury supply. Real rates are rising. By every textbook definition, gold should be trading down $50 or $100.
But it isn't.
Instead, it's rallying. It's pushing towards its highs.
It's breaking the correlation completely. We are seeing analysts scramble to ramp up their price targets, but the why is what really matters here.
It's not an inflation hedge right now. Let's be clear about that. It's a sovereign debt hedge. We are seeing massive physical buying coming out of China. The Shanghai premiums are still elevated, but the Western debt is returning too.
Why now?
Because smart investors are looking at $574 billion in quarterly borrowing, and they're looking at the Fed's CRE stress test, and they're saying, you know what? I don't fully trust the fiat system solvency anymore.
So they are buying insurance. Insurance against the Treasury market itself breaking. It's a bid on pure uncertainty and systemic risk.
And when correlations break like this, when gold rises with the dollar, you have to pay very close attention. It usually precedes a major volatility event.
Which brings us to next week. If you thought this week was chaotic, next week is a statistical anomaly that could, quite literally, rip faces off.
The triple threat.
That's what we're calling it.
I want everyone listening to pull up their Bloomberg or their trading calendar right now. Next week is a complete freak occurrence. Because of the way government service delays lined up and the short month, we are getting non-farm payrolls and CPI in the same week.
That never happens. It's unheard of. Usually you have 2 full weeks to digest the jobs report, position for the inflation print, and hedge your book. Not this time. We are getting the 2 most important data points in the global economy separated by just 38 hours.
And as if that's not enough, sandwiched right in between them, a massive Treasury refunding cycle, the very auctions we just warned you about.
It's a liquidity gauntlet. There's no other way to describe it. Let's walk through the minefield day by day so you know what to watch for.
Okay, Tuesday, February 10th. This is the sleeper event.
The Employment Cost Index ECI for Q4. Do not, under any circumstances, sleep on this release.
It's Powell's favorite metric.
He's obsessed with it, and for good reason. It measures the total cost of labor, not just wages, but benefits, too. It is the cleanest read we have on the wage price spiral.
So if the RBA is right about private demand being too strong, this is the number that will be the smoking gun for the U.S.
If ECI prints above 1.0% quarter over quarter, forget it. The cut narrative is dead on arrival. You can forget a March cut. You can probably forget May, too.
So on that release, you're watching the 2-year Treasury yield.
Immediately. If ECI is hot, the 2-year is going to smash right through resistance. The entire front end of the curve will reprice for higher for longer instantly.
Okay, that's Tuesday. Then we move to Wednesday, February 11th, the liquidity test.
We have the U.S. Treasury 3-year auction, $58 billion of paper hitting the street.
The 3-year is the belly of the short end.
It is. So we need to watch the auction metrics very closely. Watch the bid-to-cover ratio. If that drops below 2.4, it's a sign of weak demand. But more importantly, you have to watch the tail.
Explain the tail for us.
If the auction tails, it means the Treasury has to pay a higher yield to sell the bonds than what the when-issued market was pricing just minutes before. It means the dealers are choking on the supply. A tail on Wednesday is a massive red flag for all risk assets.
And while the dealers are trying to digest that massive supply, at 8:30 a.m. Eastern Time, we get the delayed non-farm payrolls report.
This is the confusion point. Usually NFP is a Friday event. Having it on a Wednesday throws all the weekly algos and positioning models into chaos.
What's the key level you're watching?
The unemployment rate itself. We are hovering right at 4.3%.
Which is the Sam rule trigger point.
Exactly. If we break above 4.3%, say to 4.4 or 4.5, the recession narrative takes over completely. The bond market will rally hard on that, but stocks might puke on the growth fears. However, the bigger risk right now, especially given the RBA news, is a no landing print.
A hot number.
Yeah. If NFP comes in above, say, 200,000 jobs added and the unemployment rate actually ticks down, we have a serious overheating problem. That confirms the RBA thesis. The Fed is completely cornered.
So Wednesday is guaranteed to be volatile. But Thursday?
Yes.
Thursday is the global anchor.
Thursday, February 12th, the 10-year note auction. Another $42 billion.
This, to me, is the most dangerous event of the entire week, period. The 10-year yield is the discount rate for the entire planet. Every asset is priced off of it.
And if we had a bad 3-year auction on Wednesday and the data has been hot, the 10-year auction could be a complete disaster. We are looking for a tail greater than 1 basis point. If we see a 2 or even a 3 basis point tail on the 10-year.
What happened?
Expect a bear steepener.
Let's look at the mechanics of that for a second. That's when long-end yields rise faster than short-end yields.
It's toxic for markets. It destroys the long-duration trade. It hurts tech. It hurts real estate. It hurts anyone holding those leveraged 60-40 portfolios. A failed 10-year auction is the kind of catalyst that sends the NASDAQ down 3% in a single day.
Okay, and then if you somehow survive all of that, you get to the final boss on Friday.
Friday the 13th, no less. U.S. CPI for January.
The algorithm breaker.
Ignore the headline number. I'm telling you, ignore it. Oil is volatile. Food is noisy. You need to look at one thing and one thing only. Supercore. That's core services ex housing.
This is what the Fed is targeting. Medical services, insurance, transportation costs. The really sticky stuff.
If supercore accelerates, if we see 0.3% or, God forbid, a 0.4% month-over-month print on supercore, and you combine that with a hot ECI from Tuesday, the market will be forced to price in a potential hike. Not a cut, a hike.
A hike in 2026? Are you serious?
Is not the base case, of course not.
Yeah.
But the probability becomes non-zero. If Australia is hiking and U.S. supercore is accelerating, the market absolutely has to hedge for it. And I can tell you right now, nobody is hedged for a Fed hike.
That is the ultimate pain trade. Okay, so let's map this all out. We have a week that could confirm a recession, confirm an overheating economy, or literally break the bond market. How do we position for this? Let's run the scenario planning.
Okay, scenario A, we'll call it the hawk's return. This is the full-blown re-inflation trade.
What are the conditions for that?
ECI comes in hot, greater than 1.0%. NFP is strong, over 200K jobs. And then CPI on Friday beats expectations, especially on that supercore number.
So the economy just running way too hot.
Exactly. The reaction is predictable. The 10-year yield breaks 4.5% and starts heading for 4.7. The dollar rips higher, DXY goes to 106, and tech gets absolutely crushed.
Specifically, the high valuation, no profit tech.
Anything with a PE over 30 gets taken to the woodshed. It's simple duration math. In this scenario, you want to be short duration, so short treasuries. You want to be long the US dollar, and you want to be short the NASDAQ. You might also want to be long energy here as a secondary inflation hedge.
Okay, that's the nightmare scenario for the bulls. What about scenario B, the elusive Goldilocks?
The soft landing. This is what the bulls need to save the entire quarter. The conditions here would be ECI cools down to around 0.8%, NFP is steady, Goldilocks number like 100K to 150K, and then CPI on Friday cools down.
So all the pressure comes off the Fed.
Right. The reaction is a massive risk-on relief rally. The S&P 500 tests its all-time highs. Yields drop. Gold probably holds its high ground because the cut is back on the table for the summer. In this scenario, you buy the laggards. You buy the small caps, the IWM. You buy those beaten-down software names.
Okay. But then there is the third option, scenario C, the stagflation nightmare.
This is the one that validates the gold breakout we've been seeing. The conditions are a toxic mix. High inflation, so CPI and ECI both beat. But at the same time, low growth, meaning the unemployment rate spikes and NFP misses badly. And to top it off, you get bad treasury auctions.
Prices are up, growth is down, and nobody wants to buy the country's debt. That's a disaster.
It's the worst possible outcome. The reaction is a volatility explosion. The VIX goes to 25, maybe higher. You get a vicious bear steepening of the yield curve, where the long end sells off on inflation fears, but the curve steepens because of the growth shock.
Where do you hide in that world?
Not in bonds. Inflation kills them. Not in stocks. The recession kills earnings. You hide in commodities and you hide in gold. Gold becomes the only asset that actually works. The trade is short equities, long commodities, and long volatility.
It's a very sobering matrix of possibilities. The RBA really showed us this week that the pivot isn't a guarantee, it's a luxury. And right now, the global economy might not be able to afford it.
My eyes are glued to that 10-year auction tail on Thursday. That is the truth teller for the week. If the rest of the world stops buying U.S. debt at these levels, the Fed completely loses control of the curve. And that changes everything.
Control your leverage going into next week. The volatility skew is signaling pain, and the global liquidity tide is clearly going out.
And just remember, next week is a statistical anomaly. Don't chase the headlines. Don't trade the knee-jerk reaction. Wait for the confirmation from the price action.
We'll be watching it all, tick by tick. This has been the Deep Dive. Prepare for volatility.
And as always, this is not financial advice. Please do your own research.
See you next week.